All right, let's jump right in. Today, we're going to break down the huge economic forces that are shaping up to define 2026. We'll be using the SBI Funds Outlook as our guide to get a handle on what's happening globally and, more importantly, figure out why India is making such a big bet on its own domestic growth.
So 2025, what a ride, right? It was a year that, kind of defied all the expectations with a surprisingly strong bounce back in global markets. So the massive question on everyone's mind is, what happens now? Where do we go from here?
And this chart really shows you just how strong that recovery was. I mean, look at precious metals like gold and industrial metals. They had an absolutely fantastic year. But here's what's really interesting. Global assets, especially in emerging markets, actually did better than assets in India. And that sets a really fascinating stage for what's coming next.
Okay, so here's what we've got on tap. We're going to start with the big picture view of the world economy. Then we'll zoom in on the strange situation happening in the US with AI. After that, we'll pivot to India's huge policy shift, see how that's supposed to kickstart spending, and then we'll wrap it all up with what this means for you as an investor in 2026.
First up, the world economic in 2026. And the subtitle says it all, really. It's basically a story of three big tensions playing out across the entire globe.
So let's look at the growth expectations. The US is chugging along at 2%. China's looking stronger at 4.5%, but the Eurozone, it's lagging behind at just 1.1%. Let's be honest, these aren't exactly blockbuster numbers. It paints a picture of pretty slow, uneven growth across the world's biggest economy.
So what's the big takeaway here? Well, it's that each of these big players is running a completely different playbook. The US, it's almost entirely dependent on the AI investment boom. Europe is trying to use government spending to spark growth, and China is still betting on selling its stuff to the rest of us. The thing is, each strategy has its own set of risks, which makes the whole global stage feel pretty complex and, frankly, a little uncertain.
Okay, let's dig into this because it's a really fascinating story. We're calling it America's AI-fueled paradox. The headline numbers, they look great, right? But if you scratch just a little bit beneath the surface, you start to see some serious signs of stress.
This is just wow. This chart shows you how much AI is propping up the entire US economy. That blue line is the overall GDP growth. The red line, that's what growth would look like without all the investment in things like AI. The difference is just massive. Without AI, the US economy would barely be growing at all, just 1%.
But here's the other side of that coin. While all these tech companies are pouring billions into AI, this chart shows that the average person is really starting to struggle. The blue and red lines here show the rate of people falling behind on their credit card bills and other loans. And, they're both ticking up. That's a classic warning sign that families are having a hard time making ends meet.
And that stress isn't just showing up on credit card statements. The job market is also flashing some warning lights. The number of new jobs being created has slowed way down to levels that, in the past, have come right before a big economic slump. It just shows this huge disconnect between the AI boom and what's actually happening for everyday people. It really makes you question how sustainable this all is.
So there you have it. That's the US paradox in a nutshell. You've got this massive wave of AI investment and government spending that makes the economy look amazing on paper. But those big, flashy numbers are hiding some real weakness for consumers and workers underneath.
Okay, so while the US is dealing with that paradox, there's a totally different story playing out in another part of the world. Let's shift gears completely and talk about India's great policy pivot and why 2025 was basically the year of reforms. 15.7 trillion rupees. Just let that number sink in for a second. That is a huge amount of money, and that's how much cash India's central bank has pumped into the economy since late 2024. A number that big tells you one thing. This is a massive, deliberate push to get the economy firing on all cylinders.
So how'd they do it? Well, this chart breaks down their toolkit. We're talking about big interest rate cuts, letting banks lend out more of their cash, and even buying up government bonds. Every single one of these moves is designed to do one thing: make it cheaper and easier for businesses and people to borrow money and, spend it.
And this wasn't just about tweaking interest rates. No. 2025 saw a whole wave of major fundamental reforms. We're talking personal income tax cuts, simplifying the whole tax system, new rules for labor. They even opened up massive sectors like insurance and nuclear power to more outside investment. It was seriously a power-packed year. Okay, so you've got all this policy action. The big question is, what's it all for?
What's the end game? Well, that brings us right here, to the consumption and credit revival. This is what's being set up to be the real engine of India's domestic growth story.
And here's the direct line they're trying to draw. The whole point of these policies is to get banks lending again. The forecast is for credit growth to jump to a really strong 13 to 14%. And that, in turn, is expected to power the whole economy to a very healthy 11% growth.
All right, now let's zoom in on a really crucial piece of this puzzle, the rural economy. And it all begins right here. What this chart is showing us is that inflation in rural India has dropped to an all-time low. This is the absolute foundation for a consumer comeback.
And when inflation is low, what does that mean? It means your money goes further. So as this next chart shows, real rural wages, that's how much people's pay is growing after you account for prices, are now climbing at their fastest speed in more than a decade.
So you've got lower prices, you've got wages that are actually growing. What's the result? Boom! Confidence. This last chart shows that people in rural areas are feeling much more optimistic. So you see the story, right? Lower inflation leads to more spending power, which leads to more confident consumers who are ready to go out and spend. It's a powerful chain reaction. All right, we've looked at the world, we've looked at India, so what does this all mean for you as an investor? Let's dive into your 2026 investor playbook and pull out the key takeaways.
The big takeaway here is that you need two different game plans. On the stock market side, things are getting more polarized, which means the gap between the winners and losers is getting wider. So it's less about buying the whole market and more about being super selective and picking individual companies. For fixed income like bonds, the game has changed. It's not about trying to guess where interest rates are going anymore. It's about finding stability and locking in steady returns.
And this quote from the report just nails the advice for bond investors. Prioritize stability and accrual over a directional duration strategy. What does that mean in plain English? It means stop trying to be a hero and bet on interest rate moves. Instead, focus on finding investments that will just pay you a steady, reliable income over time.
And that's really where we land, with this massive split in strategy. On one side, you've got the developed world, especially the US, putting all its chips on an AI boom that might be shakier than it looks. And on the other side, you have India making this huge bet on itself, on its own people, on its own domestic growth. So the question is, which one is going to pay off? That is the great economic story we'll all be watching unfold in 2026.